All right, let's talk about eHealth's second quarter earnings. Now, on the surface, this report looked pretty messy. But the way the market reacted, that told a completely different story. And we're going to dig into exactly why. And I'm not kidding when I say a different story. The moment these numbers came out on August 6, the stock just took off. It absolutely rocketed in pre-market trading, jumping as much as 28%. You see a move like that, and you have to ask, what did the market see that the rest of us might have missed? So yeah, that's the big puzzle here, right? The company actually posted a pretty sizable net loss, but Wall Street threw a party, giving it this huge vote of confidence. So what's the real story? What did investors see that wasn't obvious just from a quick glance? Let's unpack it.
It all starts, as it always does, with the headline numbers. And honestly, they were this really strange mix of good news and bad, which is exactly why you have to look a little closer to see what's really driving things.
Here's the heart of that confusion. On one hand, you've got revenue, which came in ahead of what analysts were expecting. That's a clear win. But then you look at the other side, and the company reported a pretty messy loss per share on a GAAP basis. It's this kind of divergent story that can really leave people scratching their heads.
Let's get into the specifics. So yes, that revenue number, $60.8 million, it was actually down 8% from last year. But, and this is the important part, it still beat expectations. Now, that GAAP loss of 98 cents a share, it looks rough, I know. But look deeper. Adjusted EBITDA, which gives you a better sense of the core business health, actually improved. The loss got smaller. And then, here's the real kicker, they slashed their Medicare marketing spend by 24%. That screams cost discipline, and that is something the market absolutely loves to see. Okay, so if the actual results for Q2 were kind of mixed, then why the enormous pop in the stock? Well, the answer comes from one of the most powerful things that can happen in the market, management basically telling everyone that the future is going to be way better than they'd previously let on.
The outgoing CEO, Fran Soysman, he just came out swinging on the conference call, setting this really confident, bullish tone. And, this quote, it's not just your standard corporate fluff. This is a direct signal to investors that the company feels like it's firing on all cylinders and handling a really tough environment. And that confidence, it flowed right into their updated forecast. First up, they boosted their full-year revenue forecast. And look, they didn't just nudge it up a little bit, they raised the entire range by $15 million. That tells you the Q2 revenue beat wasn't some kind of fluke. They're seeing real, sustained strength ahead for the rest of the year. But this is where this story gets really good. Just look at this flip in the net income forecast. They went from predicting a potential $10 million loss for the year to now guiding for a clear profit, somewhere between $5 and $26 million. That is a massive swing that completely rewrites the entire narrative for 2025. And just to put a cherry on top, that adjusted EBITDA forecast got a huge lift too. We're talking up $20 million at the low end of the range. The message here is crystal clear. Management is promising higher sales, much better profitability, and strong operations. That is the story that sent the stock flying. Okay, so we've got the headline numbers, we've got the huge guidance raise, but what else was management talking about on the call? Let's read between the lines a bit and see how the bigger strategic picture is coming together. First, though, a really quick primer on a metric that is absolutely critical for this business, lifetime value, or LTV. All this really is the total profit eHealth expects to make from a single customer over their entire relationship. For a business like this, it's kind of the North Star for measuring how healthy their growth is.
And their LTVs, they're looking really strong, especially for their Medicare supplement plans, where LTV jumped 29% from last year. That's a huge signal that their unit economics are getting better. They also talked about a successful AI voice agent they're piloting to make their call centers more efficient, which is great. Oh, and they mentioned this massive $917 million asset on their balance sheet. It's basically future commissions that they're looking to monetize. All of this, on top of that cost control, points to a company that's really starting to execute on all fronts.
So, you put all that together, what does it mean for the stock from here? This brings us to our final take. Let's look ahead to what's next and what we think happens from here. Our rating on eHealth is outperformed, plain and simple. This guidance raise was a huge credibility-building moment. We think the market is going to reward them as they hit these new higher targets. The whole risk-reward picture has really shifted to the upside here. So here's what we're watching. First, for Q3, we're expecting a softer quarter. Management basically told us as much, so no surprises there. The real test is going to come later in the year during the big annual enrollment period. But the biggest potential game changer, it's that nearly billion-dollar receivable asset.
Management is actively looking for ways to unlock that value. If they can pull off some kind of smart deal that brings in capital without hurting shareholders, it could force a complete re-rating of the entire stock. It's this massive catalyst, kind of hiding there in plain sight. And that's what could really define the next chapter for this company.
And of course, a quick but important reminder, this is not financial advice. Our explainer is just for informational purposes. You should always be sure to do your own research.